Hey guys, Brendan here. So a common question I've been getting recently is that people are worried that with all of the government intervention in the form of stimulus plans, that this could lead to a rising inflation environment. And if that's the case, how can they protect their portfolio against this high inflation? And even better, how can they profit from this high inflation environment? Many are worried that the recent stimulus bills the government has passed, where they give money and forgivable loans to businesses and to individuals, could lead to a rise in inflation. And that's because to fund these programs, the government is printing money to be able to give it out to the individuals and businesses. And in the short term, this can help prop up an economy, but over a long period of time, it can actually hurt the economy. If you want to learn more about printing money and more about this topic, you can view a recent video of mine that I'll post here. So as an example of the effect that inflation has, let's look at a gallon of milk. In 1913, you could buy a full gallon of milk for only 36 cents. Now, 100 years later, in 2013, that same gallon of milk cost $3.53. So that same 36 cents now only buys you 13 ounces of milk as opposed to a gallon. So let's see what that looks like. So right here, this is only half a gallon, but right there is about 13 ounces, and then 2 gallons of milk. So that's a big difference when you look at it like that. And it's not that milk has gotten more expensive or it's more expensive to produce or the cows are more expensive. In fact, it's actually going the other way. It's cheaper to produce the milk now than it was in 1913, but it's still about 10 times more expensive. So there are several asset classes that typically perform well in a high inflation environment. And some of those are things like tangible assets, things like real estate and commodities. There are also specific inflation protected bonds, and even plain old equities are seen as good inflation hedges. So in this video, I'm going to go into detail on each of those asset classes and explain why they're actually good hedges against inflation. And as a reminder, the goal of this channel is to help you reach financial independence and give you the option to retire early. And one way I do that is by explaining different topics like this so that you're better able to position your portfolio to take advantage of things like high inflation. So let's get into it. So one great example of an asset class that keeps up with inflation really well is real estate, particularly rental properties. So first of all, just the value of the property should increase and keep its value over time with inflation. But also, if you're renting out your home, then your rent should increase with inflation over time, so your cash flow continues to increase along with it. So while the price of your home and the cash flow you receive from the rental properties should keep up with inflation over time, there is risk there, particularly if you're only buying 1 or 2 rental properties. There's a lack of diversification risk. Maybe the area you bought these rental properties in isn't keeping up with inflation as well as the rest of the country. So one way to guard against this is to diversify for your portfolio. You could buy a bunch of rental properties all over the place, but that'd be really expensive and time consuming. So another option is to invest in real estate investment trusts, or REITs. Now, another great inflation hedge is commodities. And for centuries, the #1 hedge against inflation has been gold. And that causes gold's price to rise in global markets. And you can buy gold in a lot of ways. If you just want to buy physical gold and put it under your bed, that's an option. There's also companies where you can buy the gold and they'll store it and protect it for you. Or you can invest in gold mining companies to get exposure to gold without actually owning physical gold. But it can be a great hedge against inflation. And also commonly, just plain old equities are used to hedge against purchasing power risk. Now, over the last 50 years, inflation has averaged about 4% per year. Now, equities, as represented by the S&P 500, has averaged over 10% per year. So that's a 6% difference per year in growth. It's important to note, though, that high dividend-paying stocks actually do poorly in high inflation environments. So while I actually recommend investing in index funds and not picking individual stocks for most investors, if you do choose to pick individual stocks, it's just good to know that high dividend stocks may get hurt more in this environment that's upcoming. Now, as individuals are approaching retirement, they may not be as interested in equities to outpace inflation and all of the risks that come along with equities. And also, they may not like real estate because there's a big time commitment to finding the properties, then managing them, or finding a property management company to take care of it. So they focus on fixed income products. Now, bonds may be counterintuitive because in a high inflation environment, they typically go down because as inflation increases, interest rates also increase, which pulls down the value of bonds. However, to overcome this obstacle, there are many vehicles that are used to hedge inflation within the fixed income market. And one of the most common and popular is Treasury Inflation Protected Securities, or TIPS. So TIPS deliver the same credit quality as US Treasury bills while also hedging for inflation. So the interest rate in TIPS stays the same, but the underlying value of the bonds goes up and down based on inflation rates, which is based on the Consumer Price Index. The Consumer Price Index, or CPI, is a common barometer for inflation. It measures the weighted average a consumer pays for a standardized group of goods and is reported monthly by the Bureau of Labor Statistics. So for tips, this means that if inflation unexpectedly rises, so will the value of the underlying bonds, maintaining your purchasing power. So tips are important because they help combat the inflation risk inherent on most fixed interest rate bonds. So many bonds just have a fixed interest rate for the life of the bond and it never changes. Now the problem with this is that as inflation rises, that erodes the yield that you actually receive in this bond. So for example, if you have a bond that yields you 2% per year and inflation is 3% per year, then in essence you actually lost purchasing power on the life of that bond. So how do tips actually work? Well, they do have a fixed interest rate based on the value of the bond, but the value of the bond is variable based on inflation. So as an example, let's say that someone invests $1,000 in tips at a 1% interest rate. And the first year, there's no inflation. So that means at the end of the year, the bond will still be worth $1,000 and they will have received $10 from the interest rate, the 1% interest rate. Now for an example, let's say in the first year, rather than there being no inflation, there's 3% inflation. So at the end of the year, the bonds are worth $1,030, they go up by 3%, and also the interest received, instead of being $10, is now $10.30 because the 1% interest rate is based on the value of the bond, the $1,030. Now for an example, let's say that rather than there being inflation, there's deflation of 5%. So at the end of the year, the bond's worth $950 rather than $1,000. And then your interest received would be $9.50, still 1% of the value of the bond. But let's say it matured at the end of that year. So you'd actually still receive $1,000 rather than the decreased value of the bond, because you received the higher of the principal you invested or the inflation adjusted amount. So while the interest payments received can be based on the lower bond value, you'll still receive your principal back no matter what at the maturity of the bond. But if you decide to sell it before the maturity, then you can receive a lower value for the bond. Now, due to this flexibility, the bond can increase in value based on inflation and won't go below what you invested in as long as you hold it to maturity, you actually receive lower interest rates rather than investing in other bonds. So because of this, investors may be interested in getting higher yield by investing in corporate bonds, or if they're tax sensitive, investing in municipal bonds. And they can still get inflation protection through an inflation swap agreement. One party to an inflation swap will receive a variable or floating payment linked to inflation, and they'll pay an amount based on a fixed rate of interest, while the other party will pay that inflation rate linked payment and receive the fixed interest rate payment. Inflation swaps are commonly used by financial professionals to protect against inflation, but also to try and take advantage of the price fluctuations due to inflation. Payers of inflation are typically institutions that receive inflation cash flows as their core line of business. A good example might be a utility company because its income is linked to inflation. So they use inflation swaps to hedge against this because they already have inflation exposure in their underlying business. Now, while no one knows what inflation rates will be over time, it's important to know the tools that are available to you to try and protect yourself against this inflation risk. And by combining the right mix of real estate and risk assets and these inflation-protected securities, you can better position your portfolio for the future. Now, while all of this is important and good to know, you shouldn't allow this fear of inflation to dictate your portfolio. If you have goals over time that require a certain level of income or growth from your portfolio, then it may hurt you actually to go into these inflation-protected securities because you are giving up potential return for that extra protection. And also, don't buy too many risk assets with the idea that you need to beat inflation when you may need that money in the near future. You don't want this obsession with inflation to dictate your portfolio. You don't want the inflation tail to wag their investment dog. So let me know, are you concerned with inflation? Have you made any changes to your portfolio to try and protect or hedge against inflation in the future? Let me know in the comments below. Also, if you like this video, please hit the like button and subscribe. Hit the little bell icon so you don't miss any future videos. Take care. Bye.